Hello, everyone, and a very warm welcome to today's major markets update. Let's go back a week. This was, I believe, on Friday last week. Well, it was on a Saturday because I was unavailable that Friday. And it looked like the stock market bulls were back, but we did not get the 5 waves up. We were tracking 3 versus 5 waves. Once we would have 5 waves up, we knew we were on a more immediate path to 4,800. Now it looks like that path to 4,800 is delayed. So then the question was 2 days ago, did we get a bear market rally? Now that we have 5 waves lower on several indexes, it surely looked like the rally from August 18 to September 1st for most of the indexes we track was indeed a bear market rally. So that brings us to today's slide. It seems 4270 on the S&P 500 is inevitable. I hope you like these movies. I sure do. I think they're great movies, especially the lower one with Nemo, where the digital world was supposed to be inevitable. And of course, as we're digitizing more and more, we certainly can also look at the stock market from a digital perspective as more and more trading becomes digital. Regardless, it seems like 4270 is still inevitable. Last but not least, please remember the bigger pictures we're tracking. It could be that we've stopped for a B wave, or this B wave is going to subdivide one more time and trying to target 4,800. That is still possible. Remember, all the way back in October last year, we were already starting to look for a counter trend rally. And what we go by then is a 50 to 62% retrace. That is a normal, acceptable retrace. We don't know if it's going to go there. It could only do a 38.2% retrace, 78.6 or 88.6. That you don't know beforehand because there's absolutely zero price data available to tell you which of these retraces it's going to target. Then we also have introduced this alternative bullish wave count that we target 5,034. Now, this green wave 4 might have to be postponed in time, somewhere into October, late September, somewhere around there. And then we get this green wave 5 of this red wave 3 to about 4,800. And then we're going to still see if that is potential B wave, right? We questioned if we had a B wave top here in July, and we're going to do the same process once we get to 4,800. I must say 4,800 appears also inevitable because what we've seen so far from the July high into the August low is 3 waves lower. That is corrective price action. And then we've seen 3 waves back up. That is also corrective price action. So now we should track for 5 waves lower as a flat correction. Let's hope it's not going to turn into a triangle. That would be a 333, which is definitely more difficult to anticipate, but we'll take it day by day. I still think 4270 would be really nice and inevitable. The bottom line slide has not been updated, so let's go straight to the charts because I'd like to keep it short, brief, and simple. Here are several options for the S&P 500. Okay. First option here is that we indeed have 5 waves lower, and we are now working on a complex counter trend rally A, B, C. The orange B wave target zone was reached at today's low, and then we're going to bounce higher to about 44.90 plus or minus 10. And then we're going to get into the third wave, the fourth, and the fifth wave. All right, this all matches quite nicely with these downside targets. Here are the length of the initial decline, and here's then the initial decline's length extrapolated in time. And as you can see, the bounce high was relatively proportionate in time, more than half of the initial decline. I can totally accept that. Then on a shorter time frame, we have gray A, gray B, and as you can see, gray C here almost targeted exactly the same length in time as wave A. So also here we have nice proportionality. That is, I believe, important for the markets. It's not a can all do all type of setting, but we do need to see some rhyme or reason, not a counter trend rally that is a tenth of the initial decline. That would be quite odd. So it looks like we have A, B, C. This is my preferred path. All right. So we have the preferred path. Then we have a preferred path with an alternate, and then we have an alternate, a third option, which is the lowest odds in our opinion. So the second one is we've already completed wave 2, and we are in the starting gates of wave 3. Now the wave 2 fell definitely a little bit short of the ideal target zone, but I wouldn't be surprised, as of course in counter trend rallies, the upside disappoints and the downside surprises. So then all we got here was a 38.2% retrace. It's possible, but it is a little bit smallish. Okay, so this is of course still possible, right? So anywhere between 38.2 and 76.4. I don't have the 76.4% retrace on this fib pattern, but there you go. You can do just a reverse. And of course, the ideal path is somewhere here, 50 to 62% or 50 to 76.4%. So a 38.2% retrace, it's acceptable, but it's quite minimum. And often that is the A wave of this second wave slash B wave. And then as you can see here, we bottomed right here in the ideal target zone for this B wave. Okay. And as you can see, the B wave as well is anywhere between 50 to 76.4. So far we got almost an exact 62% retrace. So that is quite nice if you would really zoom this in. And this is the ideal target zone for this wave, B, 50 to 62%. A break above today's high will target 44.90 plus or minus 10. A break below today's low will be a first indication that we are on our way to 42.70. All right. And if we start breaking below, of course, this week's low, the wave 1 low, we are already on our way to this 42.70 level. That is the most likely scenario. Last but not least, this is the alternative, and that is that this wave 1 is subdividing. We still need a fifth wave lower, and then we get the second wave, and then we get the third to fourth, fifth wave. So as you can see, 42.70 remains on the map. We need to hold below 45.40. That is the line in the sand for the bears. If we go above 45.40, all bets are off. All this analysis is wrong. We have to do a complete redo. But for now, this looks still the most likely. A, B, C, and then we decline. Alternatively, we've already completed this wave 2, a little bit shallow, and then we're going to get, of course, a break below, and then 3, 4, and 5, though that break below could still be this orange 5 and 1. So unfortunately, with this overlapping kind of counter trend type of rally data, it's a little bit more open to interpretation, but I think we have a good lineup here in possibilities. Last but not least, intermediate term view with daily candles. We have wave 1 here. Wave 2 should ideally go a little bit higher again, somewhere around 44.90 plus or minus 10. A little bit more of a subdivision. I would do A, a B, and a C. And then 3, 4, and 5. Note that the 42.70 level is exactly the 76.4% extension of this wave 1 rally measured from this wave 2 low. And from there, we can then visit 47.90 for this wave 5, potentially wave 3, and then a 4, and then a 5. All right. So similarly here for the NASDAQ needs to hold, just like everything else, below the uptrend or the bounce high that we made. All right. A, B, and then C. And as you can see here, ideal Fibonacci-based impulse pattern targets also exactly this 100% extension. Looks also like we fell a little bit short here of this wave 2, so I wouldn't be surprised if it's going to subdivide a little bit more. So higher prices over a little bit longer period of time, a couple more days, and then 3, 4, and 5. Whatever the catalyst is for this wave 3, I don't know, and I don't care. It doesn't matter. The why never is important. As long as we hold, of course, below the bounce high, then this path is preferred. Still a little bit higher for this wave 2 than 3, 4, and 5. If we go a little bit higher and from there break below yesterday's low, wave 3 is confirmed. Okay, but again, look how well the ideal Fibonacci-based target zones match these larger Fibonacci extensions. Same here for the NASDAQ 100, though this one came closer to the ideal wave 2 target zone. Also here, the 3, the 4, and the 5 match very well with these bigger picture Fibonacci retraces and target zones. All right, we should then bottom here for wave 4, and the ideal Fibonacci-based impulse pattern lower according to the 2, 3, 4, and 5 gray. Targets 14,435-ish. And from there, a 5-1 relationship then targets the 16,600s. Shorter term time frame, same as the S&P 500. Ideally, we get an A, a B, and a C that we bottom for this wave B. A break above today's high will confirm this wave C with an ideal target zone of anywhere between 15,450 and 15,500. That's the ideal target zone. Similarly to all the other indexes, if we go above the September 1 high, all bets are off. Though I must say this is one of the cleanest impulses I've seen in a long time to the downside. 1, 2, 3, 4, 5. It is very clean. If we do get a break above the September 1st high, then these 5 waves lower were part of some sort of irregular expanded flat. Please be so kind to mute your microphone. That said, we should go to about 15,450, 15,500 ideally, and then we start 3, 4, and 5. It would match a little bit better the Fibonacci extensions for the ideal 3rd, 4th, and 5th wave, as I also showed here. It's the same, it's just more zoomed in, it's the hourly time frame. Alternatively, all of this wave 2 has already topped. It's possible. We almost reached the minimum retrace extension for this wave 2, and we break below this week's low, then that increases the odds that this wave 3 is already underway. All right, so please note the September 1st high was an exact 76.4% retrace of this decline from late July into mid-August. Semiconductors, also here, this is a very nice impulse looking structure to the downside. And also here we bottomed exactly at the lower end of the ideal B wave target zone. As you can see here, let me zoom in a little bit more right there. That's the 76.4% retrace of this rally. This rally does look ABC-ish, and then we should see another C wave higher, again above today's high targets for the semiconductors, somewhere around 3640 plus minus 20. And from there, we should then see 3, 4, and 5. I don't have them on the map yet. I want to see first if we can get a better, more pronounced wave 2. The alternative is a little bit similar to what we have here for the S&P 500, that we do see a 5th wave and then a bounce, a little screwy. Then this is 1, 2, 3, 4. I'm now working on this wave 5, and then we get to 2. Okay, it's possible. It's not my preferred scenario. It's a little bit on how do we interpret this price action. Is this a first wave, as I showed you here, and this the 3rd and the 4th, or is this simply all part of one longer first wave? That's always a little bit of an interpretation issue, but I think you kind of get the idea. Dow Jones topped exactly this wave 2/B target zone, and a drop below the August low will then target this wave 3/C. Still a question mark if this is a B wave top, yes or no. Please remember that Dow Jones has done nothing since November last year. I cannot call this a raging bull market. There is no bullish uptrend other than that we are just kind of staying above the 200-day moving average, which also longer term is kind of flattening out. This is not a steep rising 200-day moving average. So also here, the Dow Jones has not done anything soon in a year. That's not a bull market, not a raging bull market, all right? It's very little gain. The only gains you've had if you bought here was probably your dividends. That's about it. And last but not least, so these are all the indexes, is, what are other people seeing? Why did I say in the opening slide that why is S&P 4270 inevitable? Well, here is a recent post by Avi Gilbert from ElliottWaveTrader.net. And also here he is looking for 4230, 4275. Okay, if we break below support. This was posted today, but it is something from 3 days ago, 72 hours ago, for September 5th, okay, for Tuesday. So we have support, he says, at 4470, 4479. Now, if we break that support, he says it's pointing us down to this 4275 region. All right, so far so good. And in the chart, you see the same. Right? We did not get these 5 waves up. It didn't happen. It broke here below what he calls a pivot zone. And we are in the 40s, right? So this looks now inevitable. 4274. And remember, the CSA targets 4270. And that's then the larger 4th wave. And then we still have the 5th wave to come. Right? That matches really nice with this wave here, right? The 5th wave, right? 4 and then 5. And another person I love to follow is, of course, Pretzel, who introduced me to Elliott Wave a long time ago, and I'm so happy to see he's still at it. This is a post, I believe, from today. This is all free of charge. This is just posted, I think, 2 or 3 times per week, Mondays, Wednesdays, and Fridays. Definitely not the same level of detail as you are used to from me. But the bottom line is here where he states, okay, as long as we stay below 45.41, right, it suggests or implies a trip towards 42.65, 42.75. That is what he calls his first target zone. Please remember, also here, he states that we only had 3 waves down to 43.35, okay, which makes it an inflection zone. And then all we had was a 3-wave move back up, okay? So that's the 3-wave move back up, A, B, C. And that was likely 5 waves lower, and that targets then 42.65, 42.75. Now, I like to share work from other people because great minds think alike, and 2 or 3 people know more than 1 person. And if different people see the same thing, it starts to become quite inevitable, unless we're all out swimming and none of us has any clue of what we're talking about. But I think this increases really the odds that that is what's going to happen. And we are simply now trying to figure out how this counter trend rally is going to fill itself in. And indeed, that then 42.70 is inevitable. All right. That's all I have for today. Thank you so much for listening. Thank you so much for being a valued premium member. Take care, trade safe, and I'll catch you all next week. Bye.